Morning, everybody. Welcome to the morning market briefing, Monday, March 7th, 2022. Hope you're doing well. Hope you had a good weekend. Jumping right in today, we continue to look at tumultuous markets, looking just at where we stand today. Dow Futures are down about 66 basis points. They have rallied quite a bit, kind of across the board on U.S. equities from some of the lows we saw in pre-market trading. S&P futures down about 0.5%, NASDAQ futures down about 0.5%. So we are seeing at least a little bit of relief for the time being compared to where we were. Again, nobody's real excited to start Monday with futures in the red. But Ben, I want to start with you. Give us kind of the lay of the land on where markets are positioned right now, and then we'll go kind of eventually and get into an update on the Russia-Ukraine conflict and potential ways out of this thing. But where do we stand kind of as we're kicking off the week and early trading across the world?
Yeah, and you brought up a good point. I mean, the markets have really come back. When I was working on these pre-market notes, and this wasn't even at the lows of the day, it was probably about 2-3 hours ago or so, the German DAX index was down 3.1%, down 20.1% for the year. So that 3.1% was very ugly. It was kind of a sea of red in Europe. And now that's actually really rallied pretty strongly. We're only down 1.2% in Germany right now. And this just kind of talks about the volatility that we're seeing even intraday in markets right now. For the German DAX index to be down 3.1%, and again, not even at the worst levels. At the worst levels this morning, it was down about 4.5%. Now it's only down 1.2%. So a nice comeback for them. France is similar. It was down 2.7%. And this is basically based on the CAC 40 index, which is basically their equivalent of the Dow Jones Industrial Average. That was down 2.7% when I was checking just a couple hours ago. To right now, it's only down 0.9%. So market staging a really pretty good rally here early. And if we move on over to bonds, what we've seen in Europe is this flight to safety, which basically means a flight to the German 10-year bond. And that did get all the way down to 0.1% negative, 0.10% negative overnight. And now it's about back to zero. So you buy 10-year government bond, you'll get your money back in 10 years, but nothing more than that. And about 15 days ago or so, that was at 30 basis points, so a positive 30 basis points. So we've seen this dramatic rush into safe haven assets. Correspondingly to that, we do see a little bit of a rebound in the U.S. markets. When I was checking earlier, the S&P 500 was down 1.2% pre-market. Now it's only down 0.5%. So things really coming back quite a bit. If we look at gold, gold has also come back. It hit $2,000 in earlier at around 6 a.m. And now it's down to 1966, and gold is actually down on the day. Oil prices continue to be very strong. They really spiked up earlier because of the comments over the weekend that U.S. was going to cancel Russian imports of oil imports. It was up about 5%, 6% earlier. WTI, which is the West Texas Intermediate contract, that's the Texas oil, that actually hit over $130 a barrel. In Europe, you had oil prices hitting over $138 a barrel. But those have come back significantly. You're talking about 118 to 120. So massive, massive round trips of $15, $20 in oil just in the last couple of hours. Wheat, also pretty expensive. We're up to $12.94 a bushel. That's up over 50% from mid-February. So we're seeing dramatic volatility across currencies, commodities, stock indices, and it just calls for a dynamic view of events and making sure that we don't chase the latest move. So it continues to be a very dynamic situation in Europe, in the United States, and of course in Russia and in markets. So we continue to be watching that very closely, but we don't want to jump to every last move and follow every last move, because that's a recipe for getting whipsawed, and that's not something we want to do.
Yeah, it seems to me, Ben, and I'm curious if you would agree with this. This might be a little bit of an oversimplified explanation because I feel like we've had quite a few days in which, market closes in the red. It's not a good day for equity holders, but we rally off those bottoms. It seems to me that we are in a period where, due to the interrelatedness of this geopolitical conflict, the moving pieces, there's very little happening in isolation. I mean, the irony of this is it seems like Russia and Ukraine are two of the more isolated countries right now, but you have a lot of allies and a lot of people signing various different sanction packages that are going to be similar across the national footprint. A lot of people impacted in similar ways across Europe. It seems like we're kind of seeing this period in which one economy, a German economy, for instance, really has an impact early in the day on other places. And then you also have kind of this ongoing trend of people actually just coming in and buying those relative dips, actually forcing things up. So it seems like we're seeing tough times on the news, and that's spreading kind of globally, but then seeing some relief coming from those that are actually investing. I mean, do you think at a thematic level, that's kind of what we're seeing even today?
I think you're exactly right. As far as the fundamental economic backdrop, the two factors that I'm seeing that are incredibly important right now are higher energy input prices, number one, and then number two is potentially lower European demand. And also the currency impacts of this. But in terms of the United States, we've had better jobs reports. We've had better economic data. We've had better retail sales. We've had better consumer spending. Target beat earnings, Home Depot beat earnings, these Costco beat earnings last week. We're seeing companies that are actually putting up very good results. And we're seeing the U.S. economy put up very good results. And I think that continues to allow for some buying into the United States. And I think that ultimately, if you're taking your money out of Russia and if you're taking your money out of Europe, which I think is a very warranted thing to do, where are you going to put it in an era of inflation? Because otherwise your dollar is getting eroded. Are you going to put it back into Europe? Are you going to put it into bonds that yield less than inflation? You'll probably end up putting it into the best house in a bad neighborhood, which is U.S. stocks. And so I'm continuing to watch some of those flows. And I think that's why when we look at the volatility that we're seeing from a week-to-week basis, we're talking about it on Friday. With the incredible volatility last week, it felt like the market was down 5% last week. The market was down 1%. And that was the same for the week before. And I think that there was a huge escalation from Russia into Ukraine, obviously. But what's interesting to me is that we're not seeing these dramatic declines in U.S. stocks on a sustained basis. We're seeing near-term volatility, but then we are seeing buyers come back into the market, which I think is significant and suggests that, hey, there is value to be had in U.S. stocks and in U.S. markets in general.
Good deal. Thanks, Ben. Yeah, I mean, I think there is reason for optimism here. And I think we've had a lot of communication with clients over the last several weeks, as I'm sure people would imagine. And I don't think this is a departure from the tone that we've had on these morning calls. I mean, we continue to see opportunities. And I think it's relatively difficult at times to shut out the news cycle. And, I think we have certainly, I spoke with a client at length on Thursday evening that I think was a bit frustrated in some regards by my optimism. This was a client that had cash that was ready to be deployed. I think that for us, I mean, the hard thing is, when we say we see opportunities, I think it's important to realize we're not calling a bottom on the market. We're certainly not saying necessarily that we don't care about what's happening in Russia and Ukraine, although we may joke about that. What we're saying is that there are companies that are isolated from this conflict, and we don't anticipate this conflict necessarily to be something that has a long adverse impact on the U.S. economy. We're seeing spikes. Obviously, oil is the area where people are seeing the most impact, but we're still seeing some spots where there's a lot of opportunity. Earnings have been solid. Company outlooks look strong. And I think there's a good case to be made for this potentially being a period in which we look back and say, hey, we're really glad we were active during that period. Tom, at a high level, before we get to kind of the Russia update, anything you're seeing in fixed income world, anything you would add to kind of this broader conversation?
Yeah, I mean, thinking about opportunities, I think what we saw last week with money flowing out of Europe was people really attacked the 10-year treasury. It was presenting relatively good value compared to the rest of the curve, and that value got sucked out very quickly. So we've talked a lot about yield curve flattening over the last 3-4 months with the front end coming up. Last week, what we saw was actually sort of the medium end of the curve coming down. So it basically dropped from 2% to about 180. So now the spread between a 2-year and 10-year treasury is about 24 basis points now, where it was about 40 last week. But almost all of that is the 10-year treasury. And a lot of that, like we talked about with the German 10-year coming down, is moving in lockstep. That's where the value was, and people are flowing there either here in the States or in other places. And one thing that I think might be worth mentioning, last week, Sam sent out an article making the case that higher oil prices actually can push inflation down because all of that inflation gets sucked up by oil. So people start spending more on gas, they start spending money on a lot less things, and that pushes the demand side down very, very quickly. So rising oil prices actually have a deflationary impact on the economy at whole, which could be very positive. People aren't going to be out going and buying a new car if they can't afford to put gas in the car they've got. And I think that could actually be very beneficial for the inflation number. Obviously it's not the best case scenario, but it might actually have more of an effect on the demand side of things than even the Fed raising rates, in the sense that people start moving their dollars somewhere else rather than, buying all this new stuff and buying all these clothes and shoes and Coca-Cola. They'll just be putting gas in their car and keeping that money on the sidelines, which could bring inflation down more quickly towards the second half of the year.
Good deal. Thanks, Tom. Yeah, it's a great point. And I thought that was a pretty interesting perspective, one that I hadn't spent a whole lot of time thinking on. So in terms of the state of play, where we stand right now, we continue to see this Russia-Ukraine conflict become more of a war of attrition. Russia is making very slow progress. As it advances, it's continually being sabotaged and undermined, meeting much harsher resistance than I think many would have anticipated. Kharkiv resistance appears to be faltering a little bit, but still, as of now, remains in Ukraine's hands. Kyiv remains a bit of a Ukrainian stronghold, which I don't think is necessarily what people were thinking a week ago when the 40-mile convoy was coming. China has weighed in and said essentially that they remain rock solid to Russia, no matter how precarious and challenging the international situation may be. China is prepared to continue playing a constructive role to facilitate dialogue and work for peace alongside the international community when needed, but ultimately their loyalty, again, is going to lie with Russia. We have ongoing, I think still ongoing as of this moment, continued conversations between delegations from Russia and the Ukraine. The Russian Foreign Minister Lavrov and Ukrainian Foreign Minister Kuleba are meeting in Turkey on Thursday. Ben, how would you kind of summarize what each side is wanting here? I mean, I think we have a decent feel on what Russia wants, but how would you, if we're thinking specifically about Ukraine, what kind of deal could be struck to where this thing resolves sooner rather than later?
Ukraine, I think, essentially has to forego a lot of its independence that it's exhibited previously. So Russia is making these demands, but I don't think Ukraine's going to sign on for them. According to Reuters, there are 4 pieces of the Russian demand. Number 1, Ukraine ceases military action, which essentially means if Ukraine ceases military action, Russia essentially takes over. Number 2, Ukraine changes its constitution to enshrine neutrality. Number 3, acknowledge Crimea as Russian territory. And number 4, recognize Donetsk and Luhansk as independent. If they did all that, Russia says it would stop the military action. I'm seeing further clarification of what this would mean politically in Ukraine. And this is not Reuters. This is according to people familiar with the matter. Number 1, Zelensky would remain pro forma president, but Russia would appoint Boyko as PM. Number 2, Ukraine recognizes Donetsk and Luhansk. And number 3 is no NATO. So basically the same things, but it was interesting that subtlety of keeping Zelensky in there as president and then having essentially a Russian puppet in there as prime minister. So I think this is dead on arrival. We're seeing, again, delegations continuing to meet actually as we speak. And then on Thursday, Lavrov is going to meet Kuleba, as Andrew mentioned, in Turkey. So I think that we'll need to see some reconciliation of some of these demands if there is going to be more peace, something that Ukraine doesn't seem ready and willing to accept. But it is interesting that we're starting to move up the hierarchy in terms of negotiators. Having Lavrov meet Kuleba is certainly a step in the right direction from having the 2 delegations meet, which is happening today.
Thanks, Ben. In terms of the update kind of on the sanctions, I think the way Russia is playing their bond system is incredibly interesting. Tom, I don't know if you've put a whole lot of thought into this or want to comment, but Russia is essentially setting up a 2-tier bond system. They're going to pay creditors in rubles if they're on the list of countries that engage in hostile activities, which largely amounts to a default. Am I wrong?
Yeah, essentially they're saying, you guys are putting all these sanctions on us. We're just going to walk away from this debt. And I think that's really their only move. I mean, they're basically a rogue country now. It's impossible to know exactly what their debt should be paying, what the prices on their debt should be paying, or should they pay them off. So they can basically do what they want. They've basically been disconnected from financial reality. And so they might as well play ball in that arena. They haven't traded in, 4 or 5 market days. There's just no market for these things. So they can basically do what they want. And I think that's what they're going to do.
Meanwhile, the U.S. is considering banning all Russian oil here. Ben, I think you hit the nail on the head kind of on your programming notes here. I just don't know that really creates the sense of discomfort for Russia that we would like it to. I mean, I think it's probably a politically expedient move here for those in charge here in the U.S. I mean, I think there's a lot of people that have been wondering why we're still buying Russian oil. But the scale of this is such that Russia is 10% of the global oil market, but only 3% of what the U.S. actually imports to domestic uses here in the United States. It doesn't seem to be a massive impact. But what's the latest kind of on NATO and the last couple of topics on Russia?
Yeah, I think this is the first time we're actually starting to see some splintering of NATO, and we're seeing the limitations of acting alone. Because if the U.S. did do this, I really think that it would have probably more of an impact on the U.S. and U.S. oil than the administration would think. Although it's only 3% of U.S. imports, I think that you're talking about demand at the margin. When you're talking about energy demand at the margin, it can often behave asymmetrically, which would mean that there's an outsized, you're not talking about a 3% price increase. You could be talking about a 15% price increase if we cut off 3% of our imports. Now, that could be offset by more domestic production. But right now, we're continuing not to look at that. Instead, we're looking to this Iranian nuclear deal is kind of where we're pinning our hopes on and hoping that we open up some more of the Iranian oil. So I think this would probably not be a great move by the U.S. I don't think it would have an impact on Russia's pursuit of Ukraine. I don't really think it would hit the Russian economy that much. I do think that it would have an impact on the U.S. economy. So the risk reward economically does not play out well. Now, offset that with just the optics of, I can't believe we're sending money over to Russia. And I 100% get that. And there could be a nationalist case for us not to do that. But I think it would need to be phrased in that way. And I think that the administration might have some support behind that, but they would have to phrase it that way and say, hey, you know what? We are doing this because we can't morally and ethically justify sending money over to a country that's invading another country. So I think that's where the line would have to be drawn, but I'm not sure that the administration will do that. I think we'll make the economic argument, which could backfire on them.
Yeah, I think the economic argument's much tougher to make. And I think generally, I mean, even beyond this, I'm not necessarily criticizing policy. I think in general, nuanced economic arguments are generally tough to make in front of the general public for the most part. I mean, you kind of alluded to the Iran nuclear deal. These conversations have been going on for a year. I think it is interesting that Iran's position is now that the U.S. is essentially delaying these deals. Iran's looking for new initiatives from all parties. Russia's made it very clear that they don't want the fallout of a potential Iran nuclear deal to have any impact on them as it relates to their current conflict, and is a kind of end around punishment for it. So it's going to be interesting to kind of see how that plays out. Looking ahead of the week, we're going to wrap up here. Looking ahead of the week, we do have some data coming through. Tuesday, we'll get small business optimism. That's an early morning data point, so we will probably talk about that on the morning call. We've got the Apple iPhone SE launch tomorrow at 1. Wednesday, we'll get the job openings report, the JOLTS report. Thursday, we'll get CPI. We'll hear from the ECB in the morning, and we'll also have earnings from Oracle in the evening. So lots going on. We appreciate you guys, as always, for being here. We will be back tomorrow at 8:30, but we'll wrap it up there.